don't really understand where you start when you want to invest in a stock. And this video is going to show you 3 ways, at least that I look at, in order to start looking at investing in stocks. So the first thing is it needs to be in your circle of competence. If you don't have an edge, then you shouldn't bother investing in a stock. So, for example, if you sell insurance, or you're in the healthcare space, or you're a software engineer, you probably have a decent idea about which companies are good and which companies are bad. And so if you don't have any edge, you don't have a circle of competence, then why should you do better than everyone else? After all, the stock market is a huge competition in which really smart people are trying to essentially take your money. So if you don't have any edge, then you shouldn't invest in a stock at all. The number 2 thing I look for is revenue growth. So this is a debate between value investors and growth investors. Value investors will essentially look at cheaper stocks, ones with low PE ratios called price to earnings ratios. And this essentially means that stocks in this case are usually a little bit beaten down. Maybe their business isn't performing that well, that's why they're cheap. But growth investors will pay up for companies because they think that in the long term these companies will be profitable. And so there's kind of this give and take. One necessarily isn't better than the other, you just have to think through the implications of both. However, the stocks that kind of fit my circle of competence are the ones with revenue growth of generally pretty high, especially software stocks. So I'm looking in my number 2 factor for revenue growth of over 20%. The number 3 thing I'm looking for is a company with free cash flow. So this means that free cash flow is positive. In order to find out what the free cash flow is, you're going to go to the cash flow statement for a business, and then you're going to subtract capital expenditures from operating cash flow. This means that a company is actually making money rather than burning cash. And if a company has debt and is burning cash, then that's just a recipe for bankruptcy and you to lose all your money, which is not what you want. So, the 3 things I look for generally are a company within my circle of competence, number 2, with revenue growth, usually over 20%, number 3, a company with free cash flow positive. And so if you're looking for those 3 things, those are essentially a good place to start. My criteria doesn't have to be your criteria, but these are just 3 things that I look for in order to make well-informed investment decisions. Alright, hope you have a great day.